Welcome to the Explainer. Today, we're diving headfirst into the 2026 mining outlook, specifically focusing on how retail investors can build some really robust portfolio diversification. If you follow the commodity space at all, you know things are moving incredibly fast right now. But today, we're going to uncover a massive valuation disconnect that is quite literally hiding right in plain sight.
Okay, let's dive into this. We have this overarching, glaring question. Gold is smashing through historical ceilings, hitting record high after record high. So why on earth are mining stocks lagging so far behind? It's kind of the core mystery of the market right now. You've got physical commodities absolutely booming, but the companies that actually dig them out of the ground, they're heavily discounted.
Section 1. The Great Valuation Disconnect.
Get a load of this number. Right now, miners are trading at an aggregate 7 times EV to EBITDA multiple. 7. To put that staggering figure into perspective, the tech sector is hovering way up around 22 times, and broader U.S. equities are trading near 18 times. The valuation gap between the people pulling wealth out of the earth and the rest of the market is absolutely staggering.
Now, if you're wondering what that actually means for your portfolio, let's quickly translate the financial jargon. EV to EBITDA is just a standard metric used to compare a company's total value, debt included, to its pure cash profit. It's how we hunt down undervalued businesses. A 7x multiple essentially means a market is pricing these highly profitable miners as if they're, about to close up shop. It completely ignores the fact that they're generating record profits today.
Now, what's really interesting here is that valuations are sitting far below the peak of the last mining cycle. On a price-to-net asset value basis, major gold miners are trading at just 0.75 times. Junior miners are even lower, down at 0.51 times. That is way, way below their long-term historical average. The market is basically offering up a profound discount on real assets right now.
Section 2. Why miners are undervalued. Look, the industry comes with some historical baggage. Back in the 2000s bull market, the old mining industry made a lot of mistakes. They chased marginal, low-grade ounces. They racked up massive debt with terrible merger discipline. Actually, scratch that. They didn't just rack up debt. They spent capital like it was going out of style and burned a ton of shareholder trust. But the 2026 mining industry, it's an entirely different beast. Today, these companies show strict capital discipline, carry much lower leverage, and are hyper-focused on cost-effective brownfield expansions instead of wild speculative exploration. And because of that newfound discipline, we are seeing massive margin expansion. The all-in sustaining costs for these miners are hovering right around $1,800 an ounce. Meanwhile, gold is comfortably soaring past $4,000 an ounce. Because of this huge gap, these companies aren't just surviving, they are literally swimming in free cash flow. But, and here's the catch, being a great company is not the same as being a great stock. According to Analysts by BCG, while miners have completely fixed their underlying businesses, they now have to aggressively court generalist investors. They need to reset their capital allocation, build robust dividend and buyback policies, and honestly, they need to drop the dense, geology-heavy technical pitches for sharper, investor-friendly stories. They have to show the broader market their financial health. Section 3. The 2026 mining up cycle.
Let's see how this builds across 3 major macroeconomic pillars that are supercharging demand in 2026. First up, the new industrial revolution. Think about the massive metal requirements for AI data centers, EVs, and energy storage. Second, geopolitics and industrial strategy. Governments are urgently reshoring supply chains to lock down critical minerals for national defense. And third, the shifting macro picture. We're talking persistent inflation, rate cuts, and rising government debt. This perfect storm is a huge tailwind. The empirical evidence is wild. Demand is just massively outstripping supply. Central banks in countries like Poland and China are aggressively hoarding gold to diversify away from traditional fiat currencies. At the same time, silver is entering its 5th consecutive year of a structural deficit. With the boom in solar panels, the supply simply cannot keep up with industrial demand. There's just no way around it. Which brings us to a fascinating reality captured perfectly by Sprott. As financial assets become policy tools, gold becomes the hedge against the system itself. With rising U.S. debt, sticky inflation, and tense geopolitical tariff debates, major institutions are being pushed away from paper assets and directly into real, tangible, hard assets. Section 4. Gold versus critical metals.
Think of it as a two-pronged approach for wealth generation and preservation. On one side, you have gold. It remains your ultimate long-term store of value, a safe haven macro hedge against systemic shocks, and a core central bank asset. On the flip side, you have silver and copper. They are inherently more volatile, sure, but they offer explosive upside because their pricing is deeply tied to the crazy industrial demand of AI and green energy, all while facing severe structural supply deficits.
And here's a crucial nugget. Mining equities actually act as leading economic indicators. Historically, miners tend to rally and outperform very early in economic downturns. This usually coincides with yield curves narrowing, which signals broader economic stress. Then, as unemployment peaks, capital traditionally rotates out of broader equities and directly into physical metals. Watching miners gives you a vital sneak peek into broader economic shifts.
Section 5. How to diversify today.
So the crucial point is, you don't have to go out and buy an actual mining operation. You can construct a comprehensive precious metal sleeve using targeted ETFs. For stability and dividends, you might look at large-cap miners. These are the industry giants with low debt, tracked by funds like the SGDM ETF. If you're looking for rapid growth and higher leverage to rising metal prices, you might allocate to junior miners, the small-cap guys in early production, tracked by the SGDJ ETF. Combining them lets you balance stability right alongside high growth potential.
Which leaves us with one final, pretty provocative question to ponder. With the mining sector generating record free cash flow, yet trading at historic, deep discounts, are you positioned for the multi-year commodity upcycle? This massive valuation disconnect simply won't last forever as these companies keep aggressively throwing off cash. It is absolutely worth rethinking how real assets and mining equities fit into your long-term diversification strategy. Thanks for joining me on this explainer, and I'll catch you next time.